Good morning, everybody, and welcome to the UK Mortgage Market Insights for the weekend in the 20th of October 2023. I hope I find you all well. In this week's episode, we're going to be covering wages data, inflation data, right-move house prices, land registry house prices, swap rates, and then a brief update on lender rate reductions. So first up this week, we're looking at wages data. And as you can see from the article on screen, the Office for National Statistics released the data earlier this week, and it showed in the previous 3 months that the average earnings had increased by 7.8%. And for the first time in 2 years, they now outstrip the rate of inflation. Initial estimates had suggested that the average earnings would probably remain flat. But in actual fact, this actually means that wages are now rising at their fastest pace since October 2021. So on one hand, this is great news because it means that people have now got more money in their pockets, even though it might not feel like it. But on the other hand, it does cause a little bit of a worry to the Bank of England and to Jeremy Hunt, because one of the key drivers of inflation is when people are spending money. So if people have got more money in their pockets, then they often feel the need to spend that money. So we featured in this article, which is in the Daily Express, and as you can see on screen, we did reiterate our comments that this was great news for people that would feel that they had a bit more money in their pockets. But the more important data was going to be the inflation data, which was released on Wednesday. So when the inflation data was released, it actually took everybody a bit by surprise because it showed the inflation rate hadn't changed at all from the previous month. And this is going to cause a bit of a concern for the Bank of England when they next meet on the 2nd of November. So up until now, the expectations were that inflation would have dropped again. And despite the positive wages data that we've just spoken about, the general feeling was that if inflation had dropped, the Bank of England would potentially keep the base rate on hold at 5.25%. But this inflation data has thrown a little bit of a spanner into the works, and it could potentially mean that we might see an increase at the next meeting. Now, this isn't set in stone because there is the hope that the last 14 increases that we've seen are going to gradually start to feed through into the inflation figures going forwards. And the hope is that the Bank of England will hold off, keep the base rate the same, and just wait to see what happens. But because at the last meeting, the vote was 5-4 in favour of a hold, that's a very close call. So there is the potential that this time round we could see the vote go in the other direction and that there could be an increase. Now, it seems that the main driver for the inflation this time round was energy costs. And as we all know, if we drive a car, then we'll have noticed that the price of petrol at the pump has been increasing. This isn't helped, obviously, by the war in the Ukraine and the current unrest that we're seeing in the Middle East. All has an impact on the cost of oil. And with the price of oil rising, there is the potential that these fuel costs could remain higher for a prolonged period. So all eyes are going to be now on the next Bank of England meeting on the 2nd of November. And of course, as soon as we know what the base rate decision is, we'll let you know straight away. And we're only going to take a brief look at this because to me, it really isn't worth the paper it's written on. This was the latest house price information from Rightmove, in which they were reporting that prices were up by 0.5% in September. But what a lot of people have failed to realize, and what a lot of the press articles have failed to comment on, is that this is actually referring to asking prices. And as we all know, you can request a price for something, but whether or not someone's going to pay that is a completely different ballgame. Yes, people might be increasing the asking prices on their properties, but the reality is they're probably not going to get. Due to the higher interest rates that we're seeing, there is a real lack of activity in the property purchase market, and estate agents across the country are actually reporting huge downshifts in the number of properties that are actually selling. So this data from Rightmove, take it with a pinch of salt. It really doesn't give much of an indication of anything. What's more important is the next set of data that we're going to look at, which is the land registry data. So let's take a look at the numbers. And as you can see on screen, the average house price is now reported to be £291,000. And the report also goes on to say that in the last month, property prices went up by 0.3%. Now, these are actually misleading figures because land registry data is probably about 5 months old. This is looking at property purchases that took place prior to summer. And if you've been following the channel, you'll know that we've been reporting over the last 2 or 3 months that there has been a significant drop-off in activity due to the higher interest rates, and people are just not buying property. So the reality is that in another 4 or 5 months' time, when the land registry data is released, it's actually going to show some severe negative figures. Now, I'm still sticking by my guns. I did say that by the time we're finished with the property price drops, I think that we could be 10 to 15% lower year on year, but obviously that remains to be seen. But as it currently stands, These land registry figures that have been reported in the press, please do take them with a pinch of salt, because in reality, the numbers are not showing what things are really like on the ground. House prices are dropping, properties aren't currently selling, and lenders are trying to do all they can with their rate reductions, but it's just not having a big enough impact. So we don't think that the property market is going to really improve until probably the end of the first quarter of next year, in my opinion. But obviously, that remains to be seen. Next up, we've got the weekly look at the swap rate chart. And as you can see on screen, swap rates have increased very slightly this week, probably on average by around about 0.25%. So if we remember back at the beginning of the episode, we were looking at the wage data and then we were looking at the inflation data, and there was a bit of conflicting information, but obviously there were some concerns with what we were seeing, and this has now been reflected in the swap rate market. Now, unfortunately, I don't have the screenshot of last week's swap rate data, but if I did, you would actually see the comparable information, and across all years, in particular 2, 3, and 5, swap rates have gradually increased this week. Now, what is this going to mean for mortgage pricing? So there is the potential for it to have an impact on lenders' rates. We have been seeing lenders reducing their rates of late, but this could now have a little bit of an impact. And who knows what we're going to see. Will rates stay on hold, or will lenders continue to decrease their rates? That's what we're going to look at next. So this week has actually been quieter with lenders reducing their rates. There have been a few. Probably most notable was the TSB. And it seems that quite a few lenders are now starting to introduce more 3-year fixed rates, which haven't really been a feature in the past. Most people have focused on 2 years or 5-year fixed rates. But a lot of lenders are now seeming to focus their attention on 3-year fixed rates, which is a pretty good balance, to be fair. Be interested to know what your thoughts are, whether or not a 3-year fixed rate is something that you would consider. But as I say, it's been a bit more quiet this week, and we haven't seen as many lender rate reductions in the residential market. What we have started to see is buy-to-let lenders improving their stress test calculations, which is meaning that landlords can potentially borrow a little bit more money than they could previously. And we've got one lender in particular that is offering some pretty good stress test calculations, even for those that have got large portfolios in the background. As long as you're remortgaging and you're not borrowing any extra money, then the calculations are actually quite favorable. So if you're a buy-to-let landlord and you're looking to do a remortgage, why not get in touch? Because we can probably assist you with something where we couldn't previously. Interesting to note, though, on this point, that one lender announced yesterday that they were actually now going to increase their interest rates. This was due to the swap market volatility. And as I did say in one of my earlier videos, the inflation data that we saw could potentially have an impact on what the Bank of England do. This has spooked the markets a little bit, and as a result, we've now seen this one lender announce some rate increases. Now, to be fair, this lender is particularly open to the money markets. They do borrow most of the money they lend from the money markets, whereas a lot of other lenders actually lend the money that they have on deposit from their customers. So they're not as heavily reliant on the money markets. There is the hope that we will continue to see some competition towards the end of the year, because lenders have got some targets to hit. So they are going to be focused on hitting those targets. And probably the only way to do that and to stoke a little bit of interest is to create competition by offering lower rates. So let's watch this space on the lender rates. We will keep you posted. And so that brings us to the end of this week's episode. Hopefully you found the information useful. Hopefully it's given you a little bit of background on to what's going on in the property and the mortgage market this week in the UK. We'll be back at the same time next Friday. In the meantime, there'll be lots of daily content for you to watch on all of our social media platforms. So please do take a look. But as usual, thanks for watching. Thanks for your support in the channel. You have a great weekend. Take care.